Hi everyone. Welcome to your monthly Edmonton Real Estate Report, delivering a deeper economic snapshot and the latest on local housing trends. Activity in the Greater Edmonton Area, GEA real estate market slowed in August, selling 2,382 units to mark a decrease of 16.5% from July 2025 and 7.8% from August 2024. Although new listings dropped by 10.5% month over month, they are still up 11.6% from last year, driving inventory levels 24.6% higher than in August 2024. Average days on market has also begun to increase, taking 4 days longer on average to sell a property in August 2025. For the second time in a row, the average selling price across all residential property types has decreased very slightly month over month. Though at $461,000, the average is still 6% higher than the previous year. The MLS registered Trademark Home Price Index composite benchmark price in the Greater Edmonton Area was $428,000, reflecting no change from July 2025, just over 5% increase from August 2024. Despite the hotter temperatures in August, the market definitely cooled. The number of properties listed and sold in August was lower in all categories, which is typical for this time of year. As school starts up again and life gets busier, the buyers and sellers that are left in the market will have to change up their tactics a bit. Sellers will have to make sure they're priced right and showing their best, while buyers will be able to negotiate with motivated sellers. Data by property type. Detached home average prices decreased slightly month over month to $570,000, while the year-over-year change reflected a 4.5% increase. Semi-detached property prices also cooled last month, falling 2.3% from July 2025. But that's 1.4% higher than in August 2024. Row townhome prices rebounded a small amount, averaging $301,000, a 1.5% monthly increase and a 3.5% increase over the previous year. Apartment condominium sales slowed in August 2025, dropping 9.5% from the previous year. In August 2025, Canada saw a significant job loss, 65,500 positions, mostly in part-time roles. The unemployment rate jumped to just over 7%, the highest outside pandemic years since May 2016. Service industries shed a net 67,000 jobs, notably in professional, scientific and technical services, transportation, warehousing, and manufacturing. Only construction bucked the trend, adding more than 17,000 jobs. As a result, the employment rate fell, with labor participation declining, both lows since the pandemic. Yet wages remain resilient. Average hourly pay for permanent employees rose nearly 4% to $38, maintaining upward pressure on inflation. This week, economic data collectively fueled speculation of an imminent Bank of Canada rate cut at 92% likelihood for mid-September. The Canadian dollar slid, underperforming all G10 currencies amid falling oil prices, another headwind for the loonie. Canada's real GDP contracted at an annualized nearly 2% in Q2 2025, deeper than anticipated and marking back-to-back quarters of decline. Tariffs, mainly on autos, steel, and aluminum, slashed exports by 8%, with auto shipments particularly hard hit a 25% drop. In Alberta, this translates to a looming fiscal strain. The province forecasts just over $5 billion deficit for 2025-26, compared to a surplus in 2024, fueled by reduced oil revenues and the threat of tariffs. The federal government is pivoting to austerity, preserving key areas like healthcare but trimming other programs. Meanwhile, efforts to remove retaliatory tariffs are aimed at lowering inflation and easing pressure on households and businesses. The Bank of Canada projects GDP growth of around 2% for 2025-26, with inflation roughly under control near 2%, though trade uncertainty remains a big wildcard. Alberta's outlook is definitely brighter. Early forecasts included 1.5% real GDP growth in 2025, potentially improving to 2% by 2026. Alberta's budget 2025 also reflects caution. A major deficit buffer and a $4 billion contingency fund were established to mitigate tariff risks. On the population and regional economy front, Edmonton continues to outperform. Real GDP in the city is expected to grow at 3% in 2025, with ongoing robust interprovincial migration fueling housing, finance, and technical services. As we wrap up, the economic picture is nuanced. National indicators are weakening, expectations of rate cuts are rising, and regional resilience, especially in Alberta and Edmonton, is helping cushion the blow. For real estate, that means savvy pricing, motivated negotiations, and a watchful eye on upcoming monetary policy moves. Thanks for watching, and looking forward to going down the next real estate rabbit hole.